Hello and welcome to the lecture for Chapter 10. So this second half of the course will now, instead of looking at auditing in general, we'll look at specific elements of financial statements and management's assertions about those elements and what we'll do as auditors to get comfortable with the figures that are shown on financial statements. So one thing about cash and financial investments, it requires time and effort beyond the significance of the ending balance. Oftentimes companies don't hold much in the way of cash at year end, so the balance is often not very significant, but we'll give more time and attention to it for a couple of reasons. One, there's a greater risk of fraud involving cash than any other asset, and secondly, cash generally touches all other cycles. So purchases will flow through cash, receivables generated by sales will flow through cash, all of that. So what we'll look at in this chapter is, first of all, is cash and other accounts that are close to cash, called cash equivalents. Then we'll talk about financial investments. So different accounts that we'll find involving cash would be general checking, and I should say checking accounts plural. Most companies have multiple checking accounts for different purposes. There's also payroll checking accounts, which are generally done in an impress system, meaning that they're kept at a zero balance, so they're funded to cover exactly what the payroll is and no more. Petty cash, which companies often have at different locations, and savings accounts, which are pretty minimal at this point. Not many people have savings accounts. We'll also talk about cash equivalents. So those are accounts that can be converted to cash quickly with little or no penalty. So that would include money market funds, certificates of deposits, and savings certificates. So the key thing about that is that companies are inclined to call something a cash equivalent to boost their cash balance when it really isn't. So we have to distinguish between what would be considered a cash equivalent and what would be considered an investment. So the primary issue there is the term of it. So a little bit about auditors' objectives, and you'll see this kind of pattern in each category of accounts that we look at. So with regard to cash, we'll look at the inherent risk outside of internal controls, including the risk of fraud. We'll gain an understanding of what their internal controls are through both interviews, questionnaires, and flow charting. We'll assess the risk of material misstatement, so that's going to depend in large part on what the system of internal controls are, how much cash the business handles, that sort of thing. And what we're concerned about here primarily is the existence of recorded cash. So do they really have the cash they say that they do? And then are the transactions involving cash, did they actually occur? Accuracy of cash transaction is not a significant thing. Completeness, again, that's more of an issue when we look at liabilities. Companies aren't likely to want to understate their cash. Cutoff procedures, that's looking at transactions on either side of the year-end date. The next point is very important. Determining the company has the rights to recorded cash. In some cases, there will be bank agreements that require a compensating balance or a set aside. As an example, we'll agree to loan you this money if you agree to keep an average daily balance in excess of $10,000. You can't go below that or we'll call your loan. That kind of information needs to be communicated in financial statements so that a reader of financial statements would understand that all of the cash shown on the balance sheet isn't necessarily available to pay them. That would be covered in presentation and disclosure. So cash, again, as I mentioned, typically has a small balance, but everything else flows through cash. So it has the greatest temptation for misappropriation. I've said before in classes, cash is the best thing to steal, jokingly. It's not marked as the company's property. You don't have to sell it to turn it into cash. So all of those things cause it to be a high risk account. So one question arises, what do you do as an auditor if you find low-level fraud? Let's say you find out that somebody's taking $10 a week out of petty cash to buy lunch or something like that. So that kind of fraud obviously doesn't lend itself to a material misstatement of the financial statements, those sorts of things. But as an auditor, if you come across that, it's always a good practice to inform management in writing of what you found. There's a couple of reasons for that. One is that it protects the auditor against a charge of negligence later. You wouldn't want the company to sue you for doing an inadequate audit and for them to use the accusation that you found this fraud and didn't even bother to mention it, or you didn't find the fraud because you didn't mention it, and have that be a strike against you. So it's good to do that to protect against that potential charge, and then you can let the company deal with that small issue and you can move on to things that actually matter. So internal controls over caches is 2 slides here, a really useful list to have to look at later in your career. One, don't permit one employee to handle a transaction from beginning to end. We've talked about that a number of times now. That's really the essence of separation of duties. Separate cash handling from record keeping. As an example, one employee should take the deposit to the bank. A second employee should record that information in the accounting system. And a third employee should open the mail and pull out any checks that are included. Centralizing cash to the extent practical. A lot of companies will use a lockbox. So that's a PO box that their bank controls, and so they would instruct customers to pay to send their payment to a particular PO box. The bank would collect all of those payments, often multiple times during the day, scan all of the documents and email that or make that available to the client, and then automatically deposit those items in the bank. So my old company had an arrangement like that. So the benefit of that is those checks don't even enter your business. So it makes the whole separation of duties task much simpler. Making cash receipts on a timely basis, of course, is important, and encouraging customers to obtain receipts if there's a point of sale system, if that's the type of business it is. It's important to deposit cash receipts intact daily. So intact meaning don't keep out money from that for petty cash or something like that. So deposit it in full. Make all disbursements by check rather than using cash. That's, I think, pretty straightforward. It's important to deface all vouchers too, so that payments don't get accidentally duplicated. Make sure you do monthly bank reconciliations. Those are important, and have them done by somebody that's not involved in the chain of transactions. And then monitor cash receipts. So a lot of that we can do with data analytics. We can look for large duplicate transactions. We can look for unusual sources of cash transactions. This is also good. So I'm not going to go over these flowcharts in detail. I would just encourage you, whenever you come across one of these flowcharts, to take time as you're reading it and kind of walk through the steps there, just so that you start to gain some ability to be comfortable with information being depicted in this way. This is really a chart saying who is going to do what when a certain act happens. So in this case, what happens when we make a cash sale? What happens when we make a credit sale? Which parts of the company are going to do what? It's likely in the future, if you are involved in either a controller position or an auditing position, that you might be called upon to do one of these kinds of flowcharts. So any chance you get to get more comfortable with that is important. So one thing I wanted to mention is it's important to both, in the case of cash receipts, to send customers statements showing how much they owe the company. That's something that most systems, you may remember in Dynamics, we could automatically generate a statement and email it to a customer at the end of every month. It's a really good idea on those statements to provide a name and email or a name and phone number for the customer to contact if they see something that's incorrect. And here's the important part. It's really important that the name that you provide is somebody that's not involved with record keeping for cash receipts or for invoicing. The reason for that is if I'm processing cash receipts and I take a check out of the mail and I change the pay to the order of to myself and I cash it, and then that statement goes to the customer and it shows that they still owe that particular invoice, they need to call somebody in the company that isn't involved in that could then do an investigation. So it's a type of internal control to have that in place. In terms of cash disbursements, Again, you could look at this detailed flow chart to see what happens. This primarily is what we've talked about in the past, where one person is going to issue a purchase order, somebody else is going to receive the goods and indicate that what came in and was it in good order, and then a vendor's invoice is going to come in. Those three documents together are going to be matched and checked to see that they agree with each other. Once they are, then they can be approved and paid. All of this needs to happen quickly because it needs to happen in enough time for us to take cash discounts if possible. So a similar step here would be for somebody outside the chain of these transactions to receive any statements that come from our suppliers. Just like we would provide a month-end statement to our customers, our suppliers are going to provide a month-end statement to us. So again, that should be reconciled. If a supplier sends us a month-end statement and it says we owe 5 invoices totaling $11,000, somebody should look into the accounts payable subsidiary ledger and see that we also show 5 invoices totaling $11,000. Again, if there are deviations, those can be researched and either considered to be benign or could potentially indicate fraud. So that's a good thing to do as well. Okay, so risk assessment regarding cash. So it's important to get an understanding of the client and get an understanding of their internal control. And as I mentioned earlier, that can be done with questionnaires, flowcharts, or both, interviews with people that are working in that area. And we should look at the risk of material misstatement and with an eye towards what would our further audit procedures be. So some test of controls would be to do reperformance. So if there's a particular control that requires approval, then sending a transaction through and see if it gets that approval or not. So seeing if the controls are working as they're designed. Another would be to compare a sample of cash receipts to the cash receipts journal, the accounts receivable posting, and deposit slips. So see that those randomly sample some days and look at those to see if they're consistent with one another. And then look at a sample of recorded disbursements as well and make sure that the vouchers are in order, that they're being defaced after they've been paid, that they have the proper approvals, all of that. Again, based on what you find here, you would increase or decrease the next steps that you would do in the audit. So those next steps would be getting an analysis of all cash balances and reconciling them to the general ledger. Again, there could be multiple different accounts. We'll confirm cash balances with financial institutions, and I'll show you that form in just a couple of slides here. And then we'll either receive reconciliations of all bank statement or all bank accounts from the client, or we'll do them ourselves. And I'll show you that again in a minute. And then this is really important. We'll get a cutoff statement from the bank. So we'll ask the bank to give us a statement at least 7 business days out. And we'll send that request to the bank. We, the auditors, will send it to the bank, and the bank will send it directly to the auditor's office. So it won't flow through the client in any way. The main thing that we're looking for there is to see what checks cleared the bank in those 7 days after, to determine if the checks listed as outstanding on the bank reconciliation were indeed outstanding as of the end of the year. We'll also identify and investigate any unusual cash receipts and disbursements. I mentioned earlier we can use data analytics to look for either large amounts or duplicates to from the same customer or to the same supplier, those sorts of things. Any petty cash will count and list what is on hand. We'll do that with another person in the room with us so that there's no doubt that we didn't take money. Let's see what else here. We'll analyze bank transfers to any for the last week of the audit year and the first week of the following year, again, looking at cutoff issues. We'll look at any kinds of payments from or to related parties. So one of the things we'll do with the client as part of intake, the first time they're our client, we'll get them to list all of the related parties and related entities as well to the company, and then we'll update that every year. Have there been any changes to that? And so one of the things we'll look at are transactions to or from those related parties, again, because that's an area for potential fraud. And then we'll make sure that the proper presentation and disclosure is made in the financial statements. So this next slide is really a recap of what I've said so far, so I won't go into detail for that, but it's a good overview to look at when you're studying. So here's an example of a bank confirmation. So this is going to go directly from the auditor to the bank, and the bank is going to complete it and send it back to the auditor's office. And so this is telling the bank, we're aware of these accounts with these balances, we're aware of these loans with these terms associated with them, and we're asking the bank to sign off to say, yeah, that's indeed true, we see it the same way, or to indicate any additional comments. Those additional comments might be, well, there's a third loan that you didn't list here, or the loan you've listed has a different interest rate than what you show, or different terms, those sorts of things. So they would note any deviations or inconsistencies from what you've shown them. So reconciling cash is an important thing for a client to do with every single account. So it's a way to find if charges are made against your account that shouldn't be made. It's a way to include transactions in your accounting records that need to be included. So there might be transactions that hit your bank account that the client wasn't aware of, those sorts of things. So it's really important to do that. So again, here's a basic overview. You're basically taking the bank balance and adjusting for all of the things that you know about, the client knows about, that the bank does not. So that would be outstanding checks, deposits in transit, and other items. So again, that's important to do. So here's just a quick example of a reconciliation here where you're going from the bank balance, you're adjusting, and getting down to the balance per the books. This is a much simpler one than bank reconciliations you may remember from past classes, because all charges by the bank the client didn't know about have already been included in the client's records, I think with the exception of the bank service charge there. So proof of cash is something a bit different, and a proof of cash is something an auditor would do if there are perceived issues with internal controls surrounding cash. And it basically is going to reconcile the cash receipts and disbursements that the bank sees with the cash receipts and disbursements that the company has recorded and make sure those numbers are consistent with one another. So say as an example, the company receives $100,000 and somebody immediately disperses that $100,000 to themselves. So money comes into the company and flows out of the company. If you're doing a reconciliation at year end, the bank account could reconcile perfectly and you wouldn't see that inflow and outflow at all if they're identical to each other. So this system is going to catch those kinds of deviations. So the way it basically works is across the top there you have, per the bank statement, the end of the previous month, money that came in, money that left, and then the ending balance of the current month. And then below that, we're going to make adjustments for either deposits in transit, outstanding checks, or bank service charges so that we can convert, for example, the deposit figure from the bank to what the deposit figure for the company should be. And if we see a difference between what it should be and what it is, that's an indication that money came into the company and left the company in an illegitimate way. So this is an important thing to and this is probably something you haven't seen in a previous class, so please take time to get comfortable with this format. So financial investments, those include marketable securities, so the company may own stocks in publicly traded companies. Treasury instruments, which are short-term treasury bonds from the U.S. government, which are considered risk-free investments. Commercial paper are loans to other corporations, so large companies will do very short-term loans. Any mortgages and deed trusts, cash surrender value of insurance policies, those would be whole life policies. Sometimes companies take out insurance policies on the owners of the company so that if they pass, the company has proceeds to buy their stock back from their heirs. And then derivatives. Now, derivatives may require you to use the assistance of an outside specialist in valuing those. So oftentimes when companies have excess cash on hand, of course, they don't want to leave excess cash in a non-interest bearing checking account. So oftentimes they'll park money in some of these investments so they earn some kind of return on the surplus cash. So the layout here, the layout here is similar to what we saw in the past. I skipped a slide there, I apologize. We're going to look at whether the amounts presented are real assets, and is everything included, have losses been reflected? You might remember when we look at financial investments that they're going to fall under the fair value method. So at the end of every period, we'll value them based on different criteria, either reported values or values of similar assets, and we'll record unrealized gains and losses, if you remember that from your intermediate class. So looking at verifying that the client has done that and done that properly. Again, the likelihood is that people are going to be less inclined to record losses potentially, and so we'll kind of have a key eye to that. Okay, controls over financial investments, making sure that the company has or the client has formal investment policies. So what is the company's position regarding risk? If you have excess cash, should you go out and buy some obscure cyber or cryptocurrency? That probably is riskier than most companies would want to do for a short-term investment. So are there policies, and are those policies being adhered to? So does the investment committee of the board of directors approve that policy? And then are there proper separation of duties among employees for handling those kinds of securities? Are they all held in the company's name? That's important. And there should be some physical inspection of securities. Oftentimes these are held by brokers, so a letter from a broker indicating what securities are being held is often adequate. And here's a summary of the substantive procedures and the primary audit objectives as they relate to financial investments. So I hope that makes sense. I look forward to talking to you in the next lecture. Thank you.